Well, I think this underscores one of the things that we're looking for more generally, actually, which is that although a lot of short-term news flow will be dominated by COVID, which frankly is something that none of us can predict, in the medium term, we're seeing a good, robust economic recovery. And I think that this trade data just underscores what's happening in China and more broadly on that front.
But here's the thing, the narrative going right now is one of China slowing down. And so the PMIs are suggesting a contraction, but then you look at the demand environment still looking strong, not just the external demand environment. I can still rationalize the bump up in exports, led by demand coming in from developed economies. But back home, amid a time of restrictions, the demand has still been very strong, has been very robust. And so how do you join the dots on what this means for the China economic story?
Well, I haven't seen the data behind the release yet, but I think that possibly what's happening is when people look at China's recovery from COVID, they assume that everything has recovered at the same pace. But that clearly wasn't true. And there were areas such as some of the big cities or the services sectors which had been doing relatively well. But actually the countryside, some lower income people had not recovered as rapidly. They weren't enjoying recovery as much as the broader numbers would show. And so this was causing the K-shaped recovery that we hear about. And it might be that the bottom part of the K is now catching up with the rest of it. So although there's only one number, it's quite dangerous to assume that everyone is experiencing the same recovery. And it might just be this is a broadening out of growth in China rather than in response to what we've seen previously.
If you haven't seen the numbers, I just want to quickly recap those for you, Alexander. Dollar-denominated imports grew 33% year-on-year for the month of August, and exports grew 25.6% year-on-year, taking the overall trade balance higher to $58 billion. I'm still looking at the breakup and trying to search for the breakup as far as the trade surplus is concerned with the U.S., to understand how that equation is shaping up. But this is an important number even so. What does this mean for building an investment case? Because it seems like over the course of the last 2 weeks, despite data slowing, especially on the PMI front, on activity indicators, money is still flowing. Northbound flows have increased into the A shares market. And so how are you seeing this divergence? How are you rationalizing the divergence between A shares and H shares? And what does that mean for investor appetite in the region?
Oh, the first thing to say there is that the wrong reason to buy any equity is because of the economic number over the next month or so. The next month's economic outlook is not the right reason to buy a share, certainly in our opinion. What we're doing is we're buying companies on the basis of a 3 to 5 year outlook. And we're going to see some volatility along the way for sure, and that'll be reflected in economic data. But that's not what drives our investment thesis. The next thing, of course, is you need to divorce individual companies from the broader macro environment they sit in. The economy just provides some sort of an opportunity set or an overall revenue pie, but individual companies can thrive irrespective of the bigger picture. And of course, one of the great things about the A-share market, which is something that we've been enthusiastic about for years, is just the breakdown of that market, the amount of entrepreneurial energy there is there, the ongoing innovation despite some of the regulatory noises that we've seen over the past couple of months, and just the quality of some of the businesses. And so although I understand the importance of these trade figures, they don't really have anything to do with our ability to make money in some really good companies on a 3 year view in Shanghai.